Welcome, everybody. We are going to wait just a few minutes and allow everyone's audio to connect. Thank you all for taking the time to join us today for the Deferred Sales Trust Tax-Free Wealth Building Strategy Seminar. Look at everybody joining. Here you come. How is everybody's Tuesday? You picked a good one to attend. I'm really looking forward to listening to Andrew and Garrett today. I hope you are as well. A couple housekeeping items while we wait. We have disabled the audio function for you all during the presentation just to keep things streamlined, but we will be monitoring the chat. So if you have questions, please feel free to ask them in the chat. Somebody will respond either during the presentation or after the presentation if we butt up against time. The commands for Zoom can probably be found either at the very top or very bottom of your screen, depending on the device that you're using. If you're on mobile, you may have to swipe left or right to find the chat. Okay. Well, welcome everybody. My name is Susie Stratton and I work here at Prevail, and I'm actually going to kick off this seminar today. We are very thankful you all are here. Over the next 30 minutes, Prevail President Andrew Stafford and the Director of Business Strategies and Advanced Planning, Garrett Griffin, will discuss the Deferred Sales Trust, a tax mitigation strategy for highly appreciated assets. The format today is designed to be conversational and informative, but with a topic as sophisticated as Deferred Sales Trust, our objective today is to educate and introduce you to the high-level strategy. We will be covering the what, why, who, and how behind DST, as well as some of the most commonly asked questions. At the end of the event, if you'd like more information, or if you'd like to understand how DST can work as part of your personalized strategy, I highly encourage you to reach out to the advisor who invited you today. But without further ado, I will kick it off over to Andrew and Garrett.
All right, thanks, Susie. Appreciate the introduction. Garrett, exciting day here. This is going to be a fun topic.
Absolutely.
So you and I have had an opportunity to work with a ton of different business people, a lot of transactions, a lot of different things that are really exciting. When you talked to me at first about the Deferred Sales Trust, it blew my mind conceptually that this was even an option. Why do you think this is such an important topic that business owners should be aware of?
Well, Andrew, in my experience, these business owners have taken a lifetime to grow, these businesses. They're personal assets. They're emotionally tied to these businesses. So for them now to look at that ultimate exit and see their life's work, ultimately that's really what this is about, is helping them maximize that. And I see the Deferred Sales Trust as a great tool to be able to help with that. We've been involved in a lot of transactions where, the seller is looking for some ultimate price because they know they're going to get hit with that tax. And so a lot of times there may be a disconnect between themselves and the buyer. They just can't get together because of the disconnect in the purchase price. And so ultimately what I see that the Deferred Sales Trust does is it ultimately gives control back to the seller, back to that business owner, back to that real estate investor. It allows them to ultimately exit, I think, on terms that are beneficial to them.
So ultimately, if we break it down to kind of the lowest levels, we start today, and we'll dive into the topics in a lot greater detail. But for everybody joining us, it defers the taxes on any highly appreciated asset. So it could be federal, state, capital gains taxes, anybody that's trying to recapture depreciation that they've taken at the basic level, and we'll dive into it. It's a deferral process, as you mentioned before, that really puts them back into control of when and if they choose to pay those taxes.
That's exactly right. Capital gains deferral, both from the federal and state standpoint.
So in the current environment, and everybody obviously has kind of their thoughts on where we're at, but when you think of it from a social, economic, the most recent health chaos that's kind of come about us in our country, we've got a political environment that's very unique. Have you seen an uptick in transactions, and how do you think the Deferred Sales Trust plays forward in this current unique business climate that we're all participating in?
Absolutely seeing the uptick in transactions. There's multiple factors there. Obviously, the pandemic, and you've got business owners who maybe are looking at this saying, hey, my horizon might have been 10 years before my exit. But now with the pandemic and maybe current economic challenges, I'm looking at this situation going, well, geez, I don't know, is my business going to be worth that in 10 years? Is it going to be viable business in 10 years? And so you've got, I think, several transactions that are coming where these business owners are looking at this saying, maybe the time to strike now and make my exit. And so I think we're going to see that. The election, no matter which way it goes, I still think you're going to see an uptick in transactions. I foresee that just based upon, I think, that current pandemic and just so much unknown of where things are going, that I think you're going to see individuals, whether it's the business owners or the real estate investors, make a look and make a decision to say, hey, let's exit this, and maybe let's sit on the sidelines for a little while. But this gives them a great tool to actually get that exit in place.
So I want to transition for a quick second, and I want to get to the technical side of this. And we're going, for everybody on here with us today, we're going to get into how it works and who it works for. But if I'm in your shoes, I'm probably scratching my head saying, okay, so there's this process out there, allows me to defer taxes. Let's kind of remove the myth as to what it actually is. So we've packaged this Deferred Sales Trust in a unique package that allows clients to do this. From a technical standpoint, what is a Deferred Sales Trust?
Yeah, basically it's a package. It's installment sale based on section 453 of the code. So that section of the code's been around for an extremely long time. And as the Deferred Sales Trust, the trust itself and the structure that we use, it's been around for about 24 years, the group that we work with that uses it. And really what we've been able to see, Andrew, over that 24-year period is that the Deferred Sales Trust has got tested. It's gone through multiple audits. They're what we considered no trigger audits, meaning that the Deferred Sales Trust itself was not the reason that the audit occurred, but it went through these audits, and all of these audits, it came back no changes on the Deferred Sales Trust side. So legitimate tool based upon, again, section 453 of the code, installment method sales, and been used for 24 years, no adjustments from the IRS.
So ultimately it's taking this process that's been out there for a very long time, and it's repositioning it for the highly appreciated assets for clients. Now, if they choose to pay the taxes, I know we'll get into this, right? But I want to clarify, if they choose to pay the taxes, they could do that at any point in time, even though they may utilize this particular product, right?
That's exactly right. Yeah, there's flexibility, and ultimately, when do you want to pay? And I think, when we talked about one of the important aspects of this, and that's control. And you're able to control when you ultimately do then want to pay that ultimate tax burden. And so there's a lot of flexibility in the way that we ultimately structure these trusts and the corresponding notes with them.
So we promised everybody to kind of talk through the best categories as to appreciated assets and where it works best. So the DST works if you sell, obviously, any type of assets that is appreciated or that you have a low cost basis in. So could be your primary residency. It could be any type of commercial investment real estate, any property that you have. It could be a private stock position, your business, your partnership, any real asset that is appreciated. Where would you say that you find, in your experience, the primary use of the DST is most applicable, or where are you seeing the most transactions where it's beneficial to the client?
Yeah, you're right. It has multiple applications, but specifically, I think where I see it the most is sales of businesses and sales of real estate, real estate investors. And those are really the two biggest groups. And granted, there are a lot of iterations even within those groups, but I think from a broad category standpoint, those are the two groups that are affected the most and can certainly, I think, benefit by far the most from using the transaction.
So let me dive into that a little bit more, because there's a lot of people that have talked to us about this from a real estate standpoint. Obviously, selling your business, we'll go through an example of that. How is this particularly different than a 1031 exchange?
Yeah, that's a great question. Obviously, there's a lot to that, but effectively, this works as an alternative to a 1031 exchange. The 1031 exchange, as many of the real estate investors who are going to watch, and there are a lot of time restrictions with regards to identifying and closing your property. There's a lot of rules with respect to the replacement property. There's a lot of rules on then what you get to do from the depreciation standpoint. What the Deferred Sales Trust does ultimately is it takes away all those limitations and restrictions. And so ultimately, when you're able to sell your asset, what you do going forward, you have control over. You have the timing on that. You have the control over when you want to pay the tax on that. And so to me, there's some big differences there. I know that's a little bit of a high level response, but without getting too much into the weeds, that really is, though, it's an alternative to the 1031 and potentially even a rescue.
So obviously, if someone has 1031 exchange questions, today's not the day to dive into it, because all of them are unique and different. Set up a time for that. With the sale of a business, so the secondary category, I was actually talking to a client today that is working with us, and the question came up: does it disrupt the sale or the process of the sale for the buyer? So real quickly, before we dive into an example, can you talk through that?
Yeah, certainly every situation is always a little bit unique, but really there's no situation where it's going to impact the buyer at all. Now, very similar to a 1031 transaction, when you do your documentation and your real estate deal and your transactional documents, you're going to have a provision in there where the buyer is going to allow for a 1031 exchange. Going to be a very similar situation in our Deferred Sales Trust, where, yeah, you still need the participation of the buyer, but it's not going to throw them off. Ultimately, they're going to end up with the asset that they want. It's not going to disrupt the process, but certainly the buyer is going to be brought into it just so that they understand and are agreeing to and allowing the seller to enter into the transaction.
So what I think would be good, we're at the point where I want to walk everybody on here with us today. I want to walk through kind of a high level example, and then I want to pepper you with some questions after that. Okay. But first, as we think about a traditional transaction, and we've put together just a real rough scenario of someone selling their business at $10 million. Now, we understand everybody's situation's unique. Recapture depreciation, whether it's state, federal, all of those are very unique to your current situation. But at a high level, we'll walk through. You've got the traditional sale. At some point in time, buyer agrees to purchase the asset from the seller. You're going to have some expenses associated with it. So in our scenario, let's just say the sale, the proceeds after closing are roughly $9.7 million. The seller's cost basis in that is roughly $850,000. So we've got a taxable gain of roughly $8.9 million. We could have a multitude of different scenarios, but utilizing a high level, the estimated taxes due on that are roughly $2.65 million. So the net after tax on my $10 million sale is roughly $7 million.
Right.
So when you think about that, the real question for why the DST is important is, what is the value of that 2.6 million that's going away in taxes? And not the value today, but what is the future value and what type of income can that generate? So with the traditional sale, everybody understands, quick transaction. Walk me through the difference of how the DST works and how you leverage the dollars that would have gone to the IRS.
Yeah, absolutely. So if you think about your traditional sense with your sale that you just described, now what we're effectively doing is we're going to create almost this intermediary where we're going to then package and use the installment method. So instead of the seller selling directly to the buyer, we have a third-party trust that gets created. It's owned separately by a distinct separate third-party trustee. And the asset is sold to the trust immediately, basically a contemporaneous closing, and turned around and sold, transferred to the ultimate buyer. Well, what comes into the trust then is effectively the gross sales proceeds. Obviously, you're going to have some selling costs and those type of things, but you're going to get the gross sales proceeds sitting at the trust level. Now, because we have this third-party intermediary here, this third-party trustee, the seller has no constructive or actual receipt. And that's ultimately where we're going to get this viability, is that the seller has no constructual or active receipt with regards to the gross sales proceeds. So that basically means that at this point, they've continued to defer their capital gains tax. The trust effectively bought at fair market value and sold at fair market value. So the trust is sitting here basically at a wash from a tax perspective. And the client, instead of receiving their funds immediately, which would then make it that taxable transaction, they're going to get an installment note. That installment note is going to be set up most likely ahead of time. So they're going to know what that sales price looks like. They're going to know what the sales proceeds look like. They're going to meet with their investment advisor and they're going to make a determination, well, what do I want these proceeds invested in? And they're going to then, that's going to kind of dominate the terms of their promissory note in terms of the interest rate that they want to receive over that period of time. And ultimately then, as they're now going to be the creditor in this situation, they're going to dictate what that portfolio looks like. So there's some control element there as well. But more importantly, now, Andrew, and I think this is kind of back to your point, in the example before, we had a $2.65 million tax bill. Except now in this situation, because we've continued to defer the tax, we haven't received our principal, so we're continuing to defer the tax. Now, our financial advisors are able to use that excess, that additional 2.65 or 3.65, they're going to be able to use that over the period of time now of our note to generate additional interest income for the seller. So when you started talking about what is that difference, and more importantly, maybe what is the timing and the difference in the timing, that's effectively it. Is in a direct taxable sale, you've got excess money that's now going to go to the government. So you're getting clipped at 30 or 40% depending upon where you're at and exactly what type of sale we're going through. And so in that situation, if we're able to maintain that and earn interest on that over a 10-year period, a 20-year period, now it's pretty significant what that tax savings will do for us over time. And I know we've done some calculations, but on your number there with the 2.65 million, if they get a 6% return over a 10-year period and then now a 20-year period, I mean, we're going to generate an additional $3 million of interest income over the lifetime of that note. And so the impact then over time of being able to continue to defer, it's amazing what that will do for the clients in those situations.
So to recap real quick at a high level for guys like me that we both pointed out. So instead of the 2.6 million going to the IRS, the 2.6 million is invested. So you keep it at a modest, let's say 6% rate that it's going to get over time. It generates an additional $3+ million, and you got to keep the 2.6.
And you got to keep the 2.6. And that's not really talking about the other money that was part of the deal, the money that you would have normally kept to, but now we've got it in the trust also earning. So, I think if you've got effectively, you've got basically a $10 million deal. And obviously, again, we know we're going to have some closing costs there, but if you've got $10 million sitting in the trust earning, a 6% return, you're getting 600 grand a year over and over and over and over. Otherwise, you wouldn't be able to get that same return because you'd have less. You're going to have 2.65 less sitting in there. So it's that excess. It's basically, hey, I'm able to earn money off of the dollars that otherwise would have went to the government.
And now the government always wants their take in one way, shape, or form. So using your example, if you've got the $10 million sale, you're pulling 6% or 7%, whatever you choose the interest rate to be, is that taxable?
It is. It's ordinary income because basically if you look at this and we're setting this up with a promissory note, so the interest rate, which is what is being paid from the trust back to the client, is ordinary income to the client. So absolutely. So yeah, the government, they're getting their tax dollars based upon, an ordinary interest income rate there.
So I want to keep this thing moving along because we promised everybody we'd be short and brief today. Two things that I think are critical if I'm sitting in the shoes of somebody learning about this. So what protections does the seller have outside of the promissory note?
Right. So you effectively, as the note holder, you are in basically what they call a non-recourse position. Your collateral is the assets inside of the trust. So you've obviously got that piece of it. You've got the fact that as the creditor, you are dictating what that portfolio gets, how it gets managed, and the return that you're going to get. Aside from that, then there's what's called a DACA agreement that gets put in place. It's a deposit account and control agreement. It becomes a 3-party agreement, and it's for the protection of and security of the lender, the creditor in this situation. Effectively, it's a 3-way agreement between the lender, between the creditor, and between a third-party bank. And so basically what it does is it protects and essentially makes the bank the final sounding board. So you basically have to have 3 parties agree for money to move in and out. And so it's a way for the client as the seller and then becoming the creditor in that situation to know that, hey, look, nobody's going to run away with my money. The trustee's not, some other banking institution's not. So for money to move, you basically have to have a 3-way agreement between these parties for the dollars to move and flow where the client wants them to.
So I want to just kind of yes or no, I want to confirm I've heard you. So you've got this protection of the DACA agreement, which is 3 parties all have to sign off on money movement. Yep. You basically are kind of the first lien holder on the assets because you hold the promissory note. Yep. And as the seller, you get to determine where the assets are invested inside of the trust. So in a 1031 exchange scenario, and I understand that, again, each situation is unique. If you wanted to buy an additional property, you buy the property inside the sales trust, the deferred sales trust, correct?
That's exactly right. And that's one of the huge benefits is because now the money is sitting at the trust and it's not subject to 1031 exchange rules. Well, I don't have a 45 and a 180 day restriction on when I have to maybe close on something. And that's where that benefit lies, is that because I don't have these restrictions, well, I now am in control of my timing. So instead of a lot of deals, when you hit 1031, you're selling high, but then you're also buying back in high. This gives you the opportunity to truly look for the property that you want, maybe find something in a little bit lower market and execute on the deal then. The other benefit, and again, not to kind of get into the weeds, but on that 1031 exchange, where you're limited is you've got carryover basis a lot of times. So you're limited in how much depreciation you're able to continue to deduct. In a deferred sales trust, when you buy back into that new property, you're going to get to start your depreciation over again fully in those situations. So pretty powerful from that standpoint.
So let's run through a couple commonly asked questions now that we've done these, things that come up often. If I sell my business, right, and let's go back to the $10 million sale.
Yep.
Is it all or nothing?
No, that's where it's great. The seller has the flexibility to decide ultimately how much do I want to continue to defer. You could say, Well, maybe at a minimum, maybe I want to take my basis off the table. So if I do have basis that I can exchange that I'm not going to get taxed on, I can probably put that in my pocket. But maybe I want to roll everything else forward into the deferred sales trust. But again, very flexible. You could do a half and half deal. So it really is at the behest of the seller. What do they want to do in that situation? And so they're going to dictate, they're going to control.
How long does it take to set up?
Ideally, we're going to want 30 or 45 days. Obviously, there are unique situations and deals come in quick. And somebody just finds out about it and they're steaming towards the end zone, and we can always deal with those situations. But ideally, if there's 30 or 45 days to make sure all the parties are brought up to speed and educated, that's usually a good time frame within which we want to work.
What's the minimum amount that this is really effective?
Yeah, it's interesting because it's not necessarily a purchase price minimum. It's really more of is there $500,000 of taxable gain? And so when there's at least $500,000 of capital gains tax to be continued to defer, that's usually where we see that. Obviously, there's setup fees and those type of things. And so, to minimize and make it the biggest bang for your buck, that's really what we're going to want to see is that minimum of 500,000.
So that's a good segue as we kind of start to land this plane. Talk to me a little bit about, and unique situation. Talk to me about the fees. How does it work? Give me some insight on that.
Absolutely. There's certainly an initial kind of what I'll call kind of the transaction fee. It's done at the closing of the deferred sales trust deal. That particular fee, though, is what we call a conditional or a contingent fee. So the tax attorney that does the work that leads up to that, basically putting the trust together and helping with the transaction, he doesn't get paid unless the deal closes in the deferred sales trust. The other part of that engagement is that provides audit defense to the seller. So the engagement with the deferred sales trust tax attorney, when they engage and close that deal, that gives them the audit defense that if there is an audit in the future, their group will come in and provide that audit defense in that situation. On an ongoing basis, obviously you've got kind of the trust management side and you've got your financial advisor side. But effectively, the way that we look at this is that anywhere from really about 25 to 50 basis points over and above maybe what you would normally pay if you were to just do a direct taxable sale and have your own investment manager, manage that money. You're in a deferred sales trust situation, you're probably going to pay somewhere between 25 and 50 basis points over that in your kind of your normal course of business.
So as we start to bring it to a close, what do you think are the three most important kind of takeaways for those that are out there who've kind of seen this? And again, we did it at a real high level. If this piques anybody's interest, they obviously need to connect with you or the advisor that brought them, and we'll get them squared away. But give me the top three takeaways.
Yeah, I think the top three, first being that we're using the IRS code to continue to defer taxes. We're basically, we're using this packaged installment sale method. And so again, I think it's one of these, it's a tried and true piece of the code and something that we've built on, again, being used now for in excess of 24 years with no audits, or at least with no audit changes. I think, again, very, very important from that standpoint that it's a legitimate tool. I think maybe the second thing is that the multitude of applications where this works and where you can really truly leverage, I think is pretty paramount. Real estate investors have had that 1031 exchange. So they've kind of had some nugget of what they could do. Business owners really haven't had that. You don't have this where we can exchange businesses and continue to defer our taxes. And so I think it really gives the business owners a viable solution to, you say, hey, look, I'm been concentrated in this business position for a really long time. I'm really ready kind of to exit, but man, I don't want to get hammered with these taxes. This gives you a legitimate position, a solution to be able to kind of make that exit, start to diversify and get out of that over concentration in that situation. So I think the application to it, I know we talked where this is a 1031, not only an alternative, but a rescue as well. I think the real estate investors, especially now that potentially the 1031 has been nominated on, maybe even for the chopping block going forward. Well, who knows what we'll see there. But it's again, the application of both to businesses, real estate interests is pretty paramount. And I think the third part of that is, again, back to, I think, one of our very beginning comments, and that's control. We're able to set this up in a pretty amazing fashion in that you as the client are going to get to control when you want to have that liquidating event. You're going to control the assets as the creditor in this situation. You're going to control, ultimately, if you do want to receive principal at some point in time and ultimately pay your tax, you're the one in control of that. You're basically going to set up that promissory note and you're going to set those terms. And you've got control of all those aspects. And I think being able to control that and control what that tax impact looks like, because that's the great thing, I think, Andrew, in this whole situation is when you know when that tax is going to come, we can start to do some other planning for it.
That's right.
We can engineer to plan for, okay, how do we start to take these tax dollars off the table and potentially ultimately pay the tax? We can, when we've got time to do that, we have the ability. And so that gives us, again, I think, another layer of control. So again, those three things packaged, installment sale, multiple applications. And again, I think it's great for the clients because it puts them in control.
I think what's phenomenal about it is, and I'm going to dovetail a little bit on your third piece, because in today's environment, we all feel like so much is out of our control, right?
Absolutely.
And so I think from Prevail's standpoint, from our, innovation that we bring to clients, it's ultimately at the end of the day about giving them back control. And that's what this does. It's for any asset, that has a low cost basis. And as long as you're above and beyond kind of that $500,000 in taxable gain threshold, you get to choose, how much you want to put into it and how much you don't. So flexibility, control, innovation. I think it's a great concept. I love talking to you about it. Every time that we start, getting with clients, it's super exciting. I appreciate everyone's time today, being here with us. Garrett is great at working through these concepts. We wanted this to be high level exposure, kind of a Q&A and walking through an example. If anything that we've talked about piques your interest or you'd like to learn more, ultimately, get in contact with Garrett or your advisor or whoever invited you to this, and we'll schedule a one-on-one. Garrett, as always, I appreciate you, brother.
Thanks, Andrew. Thanks so much.
Again, big thank you to our hosts, Andrew Stafford and Garrett Griffin, for taking the time to have this discussion with us today. I hope you found it insightful and educational and of value. Again, we appreciate you all spending your lunch hour with us. If you haven't done so, I encourage you to connect with us on social media. There is a wealth of information out there for you to explore on all the social platforms and especially on YouTube. If this piqued your interest, again, I encourage you to reach out to the advisor who invited you today, and they can work on showing you how DST could be a part of your personalized plan. I hope you enjoy the rest of your Tuesday, and we will see you all again soon. Bye.